This sounds too crazy to be true, but it is true. One US company is worth more than the entire stock market of almost every single country in the world. That's right, if you take the market value of every publicly traded company in the United Kingdom, for example, and add them all up, you get $2.9 trillion, which is less than the market value of Microsoft, which on its own is worth $3.1 trillion. It's the same for Apple. With a $2.9 trillion market value, Apple is worth more than every publicly traded stock in Germany combined. In fact, there are several massive US companies, including Nvidia, Meta, Amazon, and others, that are worth more than the stock markets of entire countries. But the interesting thing is that it's not just international stock markets that look small compared to these US companies. The US stock market itself is being taken over by these mega corporations. Microsoft makes up over 7% of the S&P 500, the most widely followed index of US stocks. Apple makes up 6%, Nvidia makes up 5%, and so on. In fact, if you take the 10 largest US companies, they make up over a third of the S&P 500, the largest weighting for the top 10 in 50 years. Which raises the question that many on Wall Street are grappling with. Has the US stock market become too top heavy? The concern is that because just a handful of stocks make up such a big part of the market, if they fall, that could bring down the entire stock market. So should we be worried about that? Well, the short answer is probably not. But if you are worried, there's something you can do, which I'll talk about at the end of this video. But first, why shouldn't we panic about the concentration in the US stock market? We probably shouldn't panic because there are fundamental reasons for why America's top companies are so big. For instance, globalization has created a world that's the most interconnected that it's ever been. A company isn't just limited to its domestic market. It can sell products to the entire world. And if that's the case, then companies are generally going to be bigger than they were in the past when there was less international trade. Additionally, a lot of these top US companies benefit from network effects, which means that the more customers they have, the stronger they become. Think about Meta, the parent company of Facebook and Instagram. The more users that those apps have, the more appealing they become for other people to use them. Both of these factors, globalization and network effects, were brought together and turbocharged by the internet and mobile phones. Thanks to these technologies, we have companies that are benefiting from network effects at a global scale. Amazon, for example, offers consumers a marketplace to purchase goods from sellers all around the world. As you're probably very aware, few companies can compete with the variety of products that Amazon offers. These advantages that companies like Amazon have don't seem to be weakening either. We're entering a new technological era driven by artificial intelligence. And while it's still early and things can change, what we're seeing is that the mega corporations that dominated the internet and mobile phone era are continuing to dominate in the AI era. Companies like Microsoft, Alphabet, Meta, and Amazon are spending tens of billions of dollars on AI investments that could further entrench their leadership positions in the industries in which they operate. Yes, there are some smaller companies like OpenAI and Anthropic which have shown they can compete with the big boys in AI, and maybe the competitive landscape is going to shift even more in the future. But at least right now, AI is proving to be costly to develop, and that benefits the mega corporations who have the money to invest in it. And boy, do they have a lot of money. The 10 largest companies in the S&P 500 are on track to generate $581 billion in profits this year, or 27% of all profits for companies in the index. So as you can see, there are fundamental reasons for why America's top companies have grown to be so large and so dominant. And that means that even though the US stock market is the most concentrated it's been in decades, that alone isn't a reason for the market to tumble. As a matter of fact, in 2020 and 2021, the market was nearly as concentrated as it is today, with the top 10 stocks making up over 30% of the S&P 500. Yet the market has gone up from where it was back then. It's also worth noting that today the stock market isn't the most concentrated that it's ever been. If you go back to the 1950s and 1960s, you'll see that just one stock, AT&T, made up 13% of the market, while the top 3 stocks made up 28%. So those are the reasons why maybe we shouldn't be so worried about today's stock market concentration. But there is a flip side to the story. Some people believe that competition will eventually lead to the downfall of today's top companies. They point to former American giants like AT&T, General Electric, Electric and IBM as examples of seemingly invincible companies that eventually fell from prominence. AT&T, for example, was the largest company in the US for years. According to data from Deutsche Bank, in the period since 1966, AT&T was one of the top 5 most valuable US companies for 343 months or nearly 29 years. Meanwhile, GE was a top 5 company for over 30 years. That's significantly longer than the 14 years that Apple has been in the top 5 and even the 27 years that Microsoft has been in the top 5. But of course, even though AT&T and General Electric are still around today, they're shadows of their former selves. Could the same thing happen to Apple, Microsoft, and the other top companies of today? Maybe. Another thing that supports this idea that today's biggest companies won't always be so dominant is this concept known as reversion to the mean. If we look back through history, previous periods of concentration have eventually given way to periods of less concentration. In other words, stock market concentration could be like a pendulum. We have periods of high stock market concentration where a few companies really dominate. Then it swings the other way and there's less concentration in the market. Okay, so I laid out a couple arguments for why today's biggest companies might not stay big forever. But even if those arguments are right, that still doesn't mean that the stock market is going to plunge. If the stocks of today's biggest companies start to decline, other companies could rise, offsetting those declines. In fact, we've seen this take place to a certain extent already. A couple of years ago, Tesla was the 4th largest stock in the S&P 500 with a market value of $1.2 trillion. But since then, as the electric vehicle market has cooled off, the stock has fallen by nearly 60%, equal to a market value decline of almost $700 billion. Yet the impact on the S&P 500 from Tesla's decline hasn't been noticeable because other big stocks have more than made up for it. For instance, in the same time that Tesla has fallen, shares of Nvidia have soared, adding $1.2 trillion of market value thanks to a massive increase in the demand for the company's AI chips. So the demise of one or two big stocks probably won't be enough of a headwind to bring the entire stock market down. But if we see a broader decline in the share prices of America's top companies, that could have more of an impact. If we saw something like, say, the dot-com bust of the early 2000s, which led to significant share price declines for all of America's top companies at the same time, then that could bring the market down. That's not something that keeps me up at night, but if you're worried about that, then you might want to take a look at investing in equal-weighted index funds like the Invesco S&P 500 Equal Weight ETF, ticker symbol RSP. Whereas a traditional S&P 500 index fund like VOO weights its holdings by market cap, giving bigger companies a bigger weight, RSP invests equally across all of the stocks in the S&P 500. The ETF essentially reduces your exposure to America's largest companies, which is beneficial if you think that the stocks of these companies are going to underperform going forward. If you don't think that's the case or you don't have a strong opinion on the matter, then you might want to stick with the traditional S&P 500. Anyway, I hope you found this video interesting. If you want more content focused on business, investing, and the economy, hit that subscribe button.